Welcome to our third quarter video update for the year 2022. Today, I have with me my fellow portfolio manager on a private wealth team, Maria Dawes, as well as a special guest, Paul Carter, senior portfolio manager at Capstone Asset Management. Welcome, Paul, and we're so happy to have you. We have a lot of questions, and I'm sure you have a lot to say. So, Maria, I will ask you to do us the honor with asking Paul our first question.
My pleasure, Janet. Paul, you are one of the newest hires here at Capstone, and you've been with us for a few months now, but you're probably new to almost all of our viewers. So perhaps you could introduce yourself, maybe tell us a bit about where you came from and what your role at Capstone is.
Sure, I'd be happy to, Maria. So to start off, I guess, born and raised here in beautiful BC, and I've been in the investment industry for about 30 years now. That time has been split among Vancouver, Toronto, and then Washington State, where my family and I lived for a dozen years or so. And there have been a few stops along the path that led me to Capstone, but the majority of my career has been working on the investment teams of firms that invested either directly in individual stocks or with money managers that employ a variety of strategies in the equity markets. Glenn Murray and I have known each other for a number of years, and we've had discussions for a while now about me potentially joining Capstone. Recently, though, due to Capstone's growth and desire to expand its investment team, I was fortunate to be given the opportunity to come on board, which I did in June. Now, in terms of my role at Capstone, it's really twofold. First, I'm managing our new Canadian equity income strategy, which we launched for our clients this month, where we are investing in high quality Canadian dividend paying stocks. And second, I'm part of Capstone's broader investment management team, helping to manage our existing pooled funds.
So Paul, thanks for that. Usually when we give these quarterly reviews, Glenn will give us his brief take on the markets, and we could probably spend the entire time talking just about that. But maybe you could provide some general comments over what has happened in the markets during this past quarter.
Okay, well, I'll try to be brief because a lot's happened in the third quarter. We've had interest rates increasing, stock markets soaring, then falling. Russia annexing 15% of Ukraine in violation of international law. The United Kingdom announcing a mini budget that caused massive volatility in the bond and currency markets, that in turn almost caused UK pension plans to become insolvent. So it's been pretty busy. But I'd say that the biggest issues impacting the investment landscape continues to be inflation and interest rates. Now, I don't need to tell anyone how frustrating and damaging inflation has been to family budgets, but inflation also continues to drive stock and bond prices. If we go back to the beginning of the third quarter, so in other words, Canada Day, July 1st, the US Fed funds rate, which is the most closely watched interest rate on the planet because it influences almost all interest rates in the US economy, was 1.5%. And the median investor expectation was for this to increase to about 3.25% to 3.5% by the end of the year, and then to stay there for a little while. Investors were getting pretty comfortable that this interest rate path would lead to a soft landing, where economic growth contracts to the point that inflation comes under control, but not so much so as to tip us into recession. Now, because of that, stock markets had a really nice start to the quarter. For instance, throughout July and the first half of August, the US stock market climbed about 14%, and the Canadian market was up about 8%. And even bonds, which had a terrible first half of the year, bounced back 3% or so. Then came Jackson Hole, Wyoming. On August 26th, US Federal Reserve Chairman Jerome Powell made a very hawkish speech at the Jackson Hole Symposium, where he made it crystal clear to the world that the Federal Reserve was going to do what was necessary to get inflation under control, and that higher interest rates would likely result in a sustained period of below-trend economic growth. Investors worried that the chance of a recession had just gone up, and so the stock market fell for the next 7 days in a row. A few weeks later, the US Federal Reserve raised interest rates another 0.75% and projected the Fed funds rate to end the year at 4.4%, which is a full percentage point higher than what they had projected just 2 months earlier. And then on our side of the border, the Bank of Canada also raised interest rates last month by about 75 basis points, adding to volatility in our markets. So when all was said and done, on September 30th, the US stock market was down about 5% for the quarter. The Canadian stock market was down 1.5%, and international stocks were down 3.5%. Bonds managed to eke out a slightly positive return for the quarter, up about 0.5%.
Okay, so thanks, Paul, for that. Your addition to the team has allowed us to reconfigure our investment management team, which I think will be proven to be of significant value to our firm. And a part of that means you'll essentially be the lead on our Capstone traditional equity pool. So we're going to throw you right into the deep end and ask if you can shed some light on how that fund has done in the past quarter. And part two of my question is, what do we have to look forward to in terms of potential new changes or additions?
Yeah, well, the third quarter was definitely not a great one for the equity markets, pretty much worldwide, as I just mentioned. And the Capstone traditional equity pool was not immune to the pain. The pool's Series I units were down just over 3% in the quarter. While our Canadian equities focused strategies performed okay, the negative return was driven primarily from some of our non-Canadian positions that were pulled down by the market. Now, we maintained a relatively defensive posture within the pool throughout the quarter and held on to more cash-oriented investments than normal. And that definitely helped to soften the negative return somewhat. We've spent quite a bit of time recently meeting with the underlying investment managers in this pool. And I can say that we're very encouraged about some of the opportunities and some of the values that they are investing in currently. So this recent market decline hasn't caused us to lose confidence in any of the firms that we've partnered with. In September, though, we did make one very important addition to the pool that I'm really excited about. We have partnered with a Canadian investment management firm that is a new relationship to Capstone. This firm specializes in small cap equities management, and we have invested in their new global small cap fund. So we have known and followed this firm for over 20 years. It is one of the best equity managers in Canada, in my opinion, with long and successful track records in Canadian stocks, global stocks, and Canadian small cap stocks. Last year, they introduced their new global small cap strategy, which benefits from the same team and investment approach as its legacy strategies. After digging into their processes and meeting with their investment team members over the last few months, we decided to make an investment in the global small cap fund last month. Now, by being an early investor in this new strategy, we expect to benefit from a great manager employing a proven methodology in a nimble manner to a universe of relatively underfollowed small cap stocks around the world where the ability to add value over time is high. As well, this investment offers some great diversification benefits to the traditional equity pool as the overlap between the investment habitat between its investment habitat and that of the pool's other managers is extremely low.
Thanks, Paul. That sounds pretty exciting. And just switching gears a bit. So you're also heading up an entirely new strategy at Capstone that we're calling the Canadian Equity Income Strategy. Why don't you tell us a little bit about that? Some very broad brush strokes, let's say.
Sure, Janet. I'm really excited about our new Canadian Equity Income Strategy because I think it will offer our clients some benefits for their portfolios that Capstone hasn't offered before. So we have created a well-diversified portfolio of Canadian dividend-paying stocks that we expect to outperform the broad market benchmark by a significant amount over time. This portfolio will contain, at any given time, 20 to 30 common stocks of high quality Canadian companies. By focusing on Canadian dividend payers, this portfolio pays a regular income stream of dividends that can be very tax efficient for Canadian investors. Now, my background is in fundamental equity research or fundamental company research. By employing a thoughtful and thorough research approach, we are investing in market-leading companies that achieve strong profit margins and free cash flow, are relatively conservative in terms of debt on their balance sheets, and that have reinvestment policies that should enable them to continue to grow their earnings and cash flows. At the same time, our preference is for those companies that pay their shareholders above market quarterly or monthly dividends, and that have a history of growing their dividends. Now, we are value investors here at Capstone, and this value philosophy applies when picking stocks. Investors can expect the portfolio, for example, to have much better valuation measures than the broad Canadian stock market. Now, unlike Capstone's pools, the Canadian Equity Income Strategy is being managed in a separately managed account or SMA structure. That means that a client's accounts will hold individual stocks in it rather than units of our pools. One big benefit of this SMA structure is tax management. By holding individual stocks in their accounts, we are able to offer to our clients the ability to do tax loss or tax gain harvesting come tax time. As well, for those clients who in the future will want to do charitable giving, holding a portfolio of stocks with different cost bases offers clients the ability to make in-kind charitable gifts that can put more money in the hands of the charities and less in the governments.
So Paul, we actually asked this question to Glenn in our last quarterly update, and I don't think it was his favorite, but we're going to get your take. Is the glass half empty or is it half full? And yes, as we said last then, it is a loaded question, so take it however you want to.
Oh boy, that's a good question. I mean, if you asked me back in January, I think I might have given you a fairly pessimistic answer, but I'm feeling a lot better about things today. I guess, though, first, the answer really depends on your perspective. We are all dealing with an environment where inflation is high, interest rates are climbing quickly, and central bankers are determined to cool off our economies to the point where the unemployment rate jumps meaningfully. So if your family is struggling with the increased cost of living or the burden of considerably higher debt payments, or if you're in a job that could be at risk as the economy softens, or if you have family members in Russia or Ukraine, it's tough to argue that the glass doesn't feel half empty right now. However, from an investment perspective, it's hard not to think that the glass is half full. Values that we're seeing in the investment markets today are some of the best we've seen in a long time. As an example, the S&P 500 index in the US is trading at about 15 times forward earnings, well below the 5-year average. And the weighted average price to earnings ratio of the stocks in our Canadian Equity Income Strategy is currently just over 9. And that's really cheap on a historical basis. And in talking with the investment managers in our different pooled funds, they're also finding lots of great values in the areas where they're focused on, be that equities or fixed income oriented. Could the stock market go lower from here? Yeah, of course it could. Investment markets have been experiencing volatility levels quite a bit higher than average so far this year, and that's likely to continue for a while yet, because I don't think we've seen the last of disconcerting economic news. However, if as an investor, you have a longer investment time horizon, it's periods like this that should get you excited, because in hindsight, it's usually the most uncomfortable times that end up being the best time to be invested. So just a quick story. I distinctly remember Monday, March 9th, 2009, when I was living in the US. It was 6 months after Lehman Brothers went bankrupt. the S&P 500 index was down something like 45% year over year, and the US economy was right in the middle of the Great Recession. And I just so happened to be meeting that day with a well-known Wall Street strategist who shall remain nameless. Based on how stocks were acting and how dismal the economic and financial news was at the time, he was advising his clients to just get out of the stock market and go to cash. As it turned out, March 9th, 2009 was the absolute bottom of the market and ended up being arguably the best day in the history of the stock markets to buy stocks. It felt at the time like a terrible day to invest, but it ended up being the best. Now, I'm not suggesting that today is anywhere near that, but I do think, and I do feel that the odds are somewhat weighted in favor of investors right now.
Paul, thank you so much for your time, some wonderful insights, and it's a nice change to hear your perspective, and we look forward to how your talents will benefit Capstone and our clients, so no pressure there.
Yeah, thanks, Paul.
Thanks,
And
Janet.
yours. We hope you've enjoyed our update for the quarter, and please stay tuned next month for another edition of Your Wealth Matters. Goodbye for now.
Bye.